Well, thank you all for coming, and let's get started. It's 4 o'clock on Friday afternoon in Vegas, getting close to happy hour, so really appreciate you coming to this session, and will do my best to make it worth your time. I'm Jackie Ann Patterson, and before I get started too far, let me show you a disclaimer. This presentation is strictly educational. I will be talking about backtesting results, which are simulations. It's not reality, it's different from reality, much in the same way that a flight simulator is different from flying an airplane. And the thing is that if there's a pilot that crashes a lot in the flight simulator, I don't want to get in the plane with them. But once they've flown the flight simulator, it's no guarantee that there won't be any problems in the air. So it's like that with trading. We'll do our best with what we get with backtesting results and still keep a lookout for any problems as we go along. As I mentioned, I'm Jackie Ann Patterson. I'm the editor of a small publication called Backtesting Report, and I founded this publication after kind of retiring or quitting my day job really from the computer industry. I really wanted to trade for a living, and I read a book that said you can be free, and so I set out to do that, and I took a lot of classes and I traded, and I was gung-ho to do it, and I wanted to trade. And so that meant I wanted to enter orders and have a trade happen and have it be over and make some money and do that quite a bit. And so I started out with some fairly short-term trading, and after a while I learned that my psychology was maybe more geared towards a longer term, and that it took some time to research strategy, and it took some time for the market to produce gains. So I started shifting towards longer term strategies and applying those, and yet I had customers now, and customers who would ask me about shorter term strategies. So I will show you a mix of things in this talk between longer term indicators and things that happen on an hourly chart, and give a more short term look into what's happening in the market. So the things I'll talk about include the human herding behavior and how that applies to stock market breadth, and then finding turns with one of my favorite indicators, the MACD divergence, and then expanding that into the divergence count indicator and using that intraday. Now, one of the things you may notice is not on this list is ETF rotation. I have done significant research in ETF rotation, and that's kind of in the other half of my brain. So I've got sort of these two strategies that I'm using, and I'm using them on two different accounts. I'm not trying to overlay the same decision making. I'm trying to compare, and I consider it mostly forward testing that I'm doing in live trading, these different scenarios. But I get ahead a little bit. Let's talk about herding behavior. So I hope it's not insulting to compare or to say humans are animals and herding animals at that. So this photo is of people at a concert, and you know, we don't necessarily see that in the market because we're not trading under the tree in Wall Street anymore. We're all trading electronically. But what we do see is a lot of evidence of the herding behavior, including the sayings that we know, like a rising tide lifts all boats. So once the market gets going, a lot of the stocks get going, follow the herd. And then there's a couple books, The Crowd by Liban and Extraordinary Popular Delusions by McKay, that detail quite a bit of the human tendency to get caught up in the excitement and form a bubble and then have it burst and go into a panic, and basically for the herd to stampede back and forth one direction and another. Okay, well, let's look at ways that we can measure that, since we aren't able to see necessarily the herd stampeding back and forth. What we can do is measure the market breadth. And most of what I learned about doing that, I learned from Tom McClellan at the Traders Expo in Los Angeles in 2009. And Tom is the son of the actual inventors of the McClellan oscillator and the McClellan Summation index. And he gave a good talk and shared some backtesting results that basically suggested that divergences in the summation index could show market turning points. And the timing on that is not exact. It's not like it happens and then the next day the market has to turn, but it does seem to correlate. And so I went looking for the McClellan summation index aside from subscribing to his newsletter, and I couldn't really find it, so I programmed it into TradeStation. And what you're seeing here is a screenshot from the tools I use each week to check out the market. And on top is the S&P 500 in the form of the SPY ETF. And really from the bottom up, I'm building up the breadth. And at the bottom here, this yellow line is the advanced decline, the typical measure of breadth. And then that is built into the McClellan oscillator, which, as oscillators do, goes from oversold down below the green line up to overbought up above the green line and back. So this snapshot I took earlier in the week, and what do you know, we'd gone up above the green line into overbought. So we had rising breadth and perhaps pulling back into the middle zone. Well, all of this is done just so that I can plot this blue line, which is the McClellan summation index. And you know what? I was saying, oh, this was the current slide. The next slide is the current graph. I'm sorry about this. This is an older one. Comes back. We can see it down below. It's 2011. And the reason I have this up here is to show you a positive divergence, which you'll see the price of the S&P 500 goes lower and lower, and the blue McClellan summation index does not make a lower low. So this is what is meant by a positive divergence, and this is the signal that the McClellan summation index can make to indicate that it sees a rising market coming. Okay, so let me get to that next slide. There we go. This is the one that's current today, and I'm sorry about that. And so we see the S&P 500 also up at highs. The McClellan summation index has relaxed a bit. It was up at highs, but when we compare back, way back here in May-June timeframe, the McClellan was much higher, and the price of the S&P 500 was not as high. So here we have a bit of a negative divergence, and I'd say it's kind of a sloppy one because, you know, here was the clear-cut negative divergence back in July and August, and then right now we've got a hump that's a little bit bigger than it was back in July and August, but not so much compared to back in May. So it's not a real clear-cut signal, and yet what's obvious is that even though the S&P is up near all-time highs, that the McClellan summation index is not. So there's an example of how I use that to look for market turns, and in this case to know to be wary. Okay, another indicator that I use is the MACD. And how many people use MACD or are familiar with MACD divergences? Quite a few. So I won't go into depth. I just put this chart up to show that as the price makes a lower low and the MACD lines make a higher low, MACD histogram higher low, that's a positive divergence. And the thing is, I became quite enamored with this signal and had a hard time finding it, and somebody said, oh yeah, you can't find that programmatically, and I said, yeah, right, that was the challenge I needed. So I created a TradeStation macro to identify this signal programmatically, and created a service that displays the MACD divergences in the stock market every day. And one of the things that I do with that service is I backtest every week how are the signals doing, how are the MACD divergence strategies performing. And so I have over 35 variations on MACD divergence strategies, and I just took a snapshot of the top 4 and the bottom 4. And the top 4 are all long strategies, how about that? And they are all focusing on MACD lines, divergences, except for one. And to decode this DJIS stands for Dow Jones Industrial Sectors, and there are iShares, ETFs, that make that tradable. And that is shown hypothetically a 64% win rate. That's why that's colored green, because green for good, red for bad. The other highlight here is that on the weekly charts, the MACD divergences on U.S. stocks on weekly charts have not had such a stellar win rate. That's 50-something over there. But the average gain has been over 170%. Question? The question is, when is this from? From the beginning of the year. And this is from about 2 years. It's a rolling 2-year window. And the losing strategies are all short strategies. So I think MACD divergence is notorious, or it should be notorious, for having early negative divergence signals. So what has happened is the strategy has made simulated trades based on negative divergences, and it hasn't gone well. It hasn't gone well for sectors, it hasn't gone well for stocks, and it hasn't gone well for ETFs. So let's see, so that's using the basic MACD divergences.
How could you have 2,000 trades in 2 years?
The question is, how could you have 2,000 trades in 2 years? By doing it across a set of 2,500 stocks. So you could have the same stock repeating, or you could have a selection of those stocks. So this is not something that I would relate to, or this is not something that was traded live. This is very hypothetical. It's taking all the stocks across the stock market, picking out when they had a positive divergence, doing a simulated trade, getting out when there was a negative divergence, and then collecting the results. Yes, question?
What is your definition of negative divergence?
The question is, what is the definition of negative divergence? And that's, let me flip back here to when the price makes a higher high and the MACD lines make a lower high, or the MACD histogram making a lower high. That's what I call a negative divergence.
I call that a positive divergence. The negative divergence would be
Yeah, typically in the literature, this is the negative and this is the positive. The ones that the line, the MACD tilting upward is, according to Gerald Appel, who invented it. That's how he named them. So that's how I've been following them. Okay, so having collected all the divergences across the entire stock market for years, one of my customers suggested, hey, since you have this count, why don't you use it to make an indicator and keep track of how many divergences are in the stock market on any given day. And so I do that, and I call it the divergence count indicator. And you're looking at a recent plot here, and yeah, I mean it's recent. See, it says 13. And up above is the Qs. And these little markers on the Qs are indications where there's been something interesting happening in the world of divergences. So remember, I'm running across 2,500 stocks, and historically, times where there's been a lot of positive divergences, big spikes like this, that's what this middle row is showing here, is how many positive divergences were there in those 2,500 stocks. And that historically has been a pretty good time to trade. And what historically has been an even better time to trade is when there's very few negative divergences. And when you get these two things together, few negative divergences, lots of positive divergences, then the results have been pretty good. They have been more than pretty good. That's engineering speak for results are coming through quite well on just trading an individual divergence. And so this is this graph shows the backtesting report of doing just that, of looking at, first for comparison, look in the brown, just trading on MACD lines, positive divergences. And this is broken up into 3 different time periods, from 1994 to 2004, which was kind of mixed, and 2004 to 2007, which was good, stock market was going up, and 2007 to 2008, which was just the start of the decline and got really bad. And so the brown, just trading on MACD divergences, you can see that it somewhat tracks the market, that it's not a magic silver bullet here. If you get a positive divergence and then the crowd turns and the market just goes rocketing down, that trade's going to lose probably. And that's what happened here. But when you take a look at the green, and this is the absence of negative divergences, during most of the time, 1994 to 2004, that produced better results. Not so much when the market was going great guns. But when the market was going badly, waiting for an absence of negative divergences was kind of salvation here, because it didn't lose. You know, it didn't win, but it didn't lose. And similarly, but not quite as good, with the presence of a lot of positive divergences in blue, you got more wins, bigger wins, than just doing the basic MACD divergence trades. And it didn't lose quite so much in the hard times. So keeping track of how many divergences there are on a daily basis across the stock market has been helpful, and I use it based on this, I use it going forward to try and pick better times to go long in the market versus waiting. Okay, so having done that on an end of day chart, I'm now doing it also on an intraday chart. On, well, I'm counting the divergences that happen on 60-minute charts, and I'm doing it hourly at the bottom of the hour. So this is kind of an age quiz. Who knows what the bottom of the hour is? Remember the top of the hour? The bottom of the hour is at the half hour. So the market opens 9:30 Eastern Time, 6:30 Pacific Time, and so each hour thereafter I'm scanning for the divergences. And what I'm scanning, since I'm doing this hourly, is just the 500 stocks that make up the S&P 500, and also the stocks that are popular enough to have a weekly option expiration. And so once again, I'm looking for high numbers of divergences on the hourly chart. And here's a sample. It says today, but I did this last night. So this is Thursday's intraday divergences. And the green lines are positive divergences. Each set of bars happens each hour. And the red lines are negative divergences. So yesterday, the market started off pretty happy with some positive divergences and shifted more towards negative. But the thing about it is this overall, and it's probably hard to see, but none of these got higher than 35 divergences, which out of 500 stocks turns out to be not all that many. And what I wanted to do was figure out what can we say about this. So I plotted what happens what happens 4 days after you have a set of divergences. So on the vertical axis, this is the percentage gain or loss. And then going horizontally is how many divergences there were. So something like 35 would be back here in the muddled crowd. But once you start getting out towards 50, 100, this starts to have, you know, a more pronounced slant upwards to my eye. It's going up. And so I tried to quantify that a little more, and I hope this is visible. So just putting numbers to it, after 2 days, what is the expectancy? And after 4 days, what is the expectancy for different situations? So one is the baseline, which is just anything goes. That could be any reading on the number of divergences. And the market during this period I was testing, which is from about 2009, overall went up. So there was a 1% gain, 1.6% gain after 4 days. Looking at situations where there were high numbers of positive divergences, where the biggest number of positive divergences was above 50. Well, that had slightly better expectancy. It's coming up to 1.5, 2%. So that's doing better than just the whole crowd, just anything goes. And then if I instead sort for negative divergences, well, the performance was worse. It's not negative performance. So once again, the MACD divergence on a negative divergence did not signal this great shorting opportunity. And in some sense, there wasn't that many great shorting opportunities in the market. But it did signal a time for caution, that the market did not go up as much as it has in these other cases. Okay, so in summary, I've shown you a couple ways to show how to tell how the market is turning. So one is looking for divergences on breadth, looking at something like the McClellan Summation Index and looking for when it does not confirm the price. The other is looking for a breadth of divergences. So looking for cases where there's a high number of positive divergences in the market or an absence of negative divergence, and then we have a shot of having perhaps a more favorable market environment. Okay, so that's it for our regular presentations. If you'd like more information, please visit my website, Divergence Alerts, or Backtesting Report and Backtesting Blog. And are there any questions? Yes?
Is this indicator that you come up with, is it recommended
The question is this indicator I came up with recommendable for swing trader? I think the hourly 60-minute one is useful. Yes, Richard?
If you use a 14-day period, how did the divergences pan out over that period, a longer period of time?
If I used a 14-day period, how did the divergences after 14 days? And I didn't look at that with the hourly. I did look at that somewhat with the daily divergence count, and it was still kind of murky. It took a couple months really to see the overall trend emerge, I would say. Yes, question? Yes, is there anything on my website about ETF rotation? Yes, there is. And if you go to Truth About ETF Rotation, all one word, you'll find a link to everything I've got on that. So we're getting, yeah, question?
I assume you're using a 12-26-9 setting, right?
Yes.
So you're looking for divergences on, for example, on daily charts. But because of the settings, there's kind of a sweet spot in the divergences that we find. For example, there was a recent divergence in the GDX in the weekly. It was a beautiful textbook, but that was on the weekly. When you bring that out to daily, put 12.69 on the daily, you probably find it, but somebody looking at the daily chart would go, geez, I don't know. It doesn't look like the stuff I'm using, but you take it to a weekly chart, boom, you got it.
So, yes. Yes, so let's see, to paraphrase, you said, you asked about the settings, and yes, I'm using 12.26.9, and I think your comment is that when you do that, then you're going to see the things that line up with those settings, but not that line up with other settings. And then the people who use other settings might not see the 12.26, or looking at you mentioned the daily chart and the weekly. Right.
But you look at divergences that are way stretched out, you go, well, there's still a divergence because of...
Oh, yeah. So I have done some back testing on so I've looked at the compactness of the divergence. And you're right, that the divergences that are very stretched out in time do not have as good performance as the compact ones. The things that happen within 10 or 20 days have done much better. It's the function of the market surge, I think. Okay, one more and then we're out of time. Yes, sir.
Histogram and the lines, is there different results based on both of them, if they're both converging as opposed to one or the other?
Yes. So the question is, what's the difference between the histogram or the lines results? And the MACD lines tended to have larger profits, lower win rate, fewer trades. The MACD histogram traded more often, smaller profits. That was kind of the trade-off that I saw. Okay. Well, thank you very much for attending. And if you're in the live audience, please stay and we'll do a drawing.